Hello and welcome to Advanced Charting Techniques. My name is James Boyd. We welcome you on this Friday, beautiful Friday here in Salt Lake City. Hopefully that weather is where you are or it's coming to you. We like to also welcome Dean. Dean, my father's name is Dean. You're a good man with just that name alone, Dean, and we don't doubt you at all. Now, Austin, hello, Ocean Life, Fez. Welcome, Austin, Life in the Fast Lane, Luke, Kevin, and many others. Scott, aloha back to you. And Ray, welcome to all. Now, we also have in the chat Scott Thompson, a fellow, he's a manager, and but he used to be an instructor just like us. So we will have you covered here today. Scott and I used to teach the in-person events together. And so that was, let me just go back to something. There you go. Weird. Okay, there it is. So just a quick reminder, I used to teach this class, so I'm very familiar with this. And so Cameron May is out of the office. And so let's go ahead and hop right in. Today, our focus of what I want to cover is kind of like a major theme, okay? Have you ever seen a breakout and said to yourself, I'm going to get in? Or had a friend say this? Okay, it's not us. A friend says, I'm going to get in when it bounces off old resistance, new potential support, okay? Now, I think a lot of times the intention of our friend, not us, is genuine, okay? But sometimes the implementation of it, okay, it's a little lacking, okay? And I want to kind of talk about what's the potential cost of not maybe cleaning that up and fixing the problem, okay? So what I want to do here today, let's go ahead and remind ourselves. The information I talk about here today is provided for general informational purposes only, not considered an individualized recommendation, endorsement of any particular security, chart pattern, or investment strategy. You get to decide for yourself. Options carry a high level of risk, not suitable for all investors. Also remember when we talk about short options, those can be assigned at any time up to the expiration, regardless of the end of the money amount. And also remember when we talk about examples in the paper money account, they are just examples and they're used for educational purposes only. Investing involves risk, including loss of principal. Now, today, as I mentioned, we're going to really focus on the bounce setup post a breakout, okay? Now, I'm just going to quickly look at the indexes, 2 minutes or less. I want to highlight one main sector that might be where we're going to get a lot of our examples. Now, speaking of that, what sector are you looking at today? Let us know, and I won't tell anyone, okay? Now, let's go ahead just real quick, and then what we'll do is after we look at the indexes in one sector, then we're going to actually talk about kind of this, like what does a bounce look like after a breakout? And then when we talk about that, we'll talk about price action, we'll talk about candles, and we'll kind of about setting some expectations and how to prepare ourselves. And then we'll wrap into that a script as well. Now, what I'm going to do here is let me just kind of pull up, if you don't mind. I'm just going to pull up just the good old SPX for just a moment, okay? This was our fib lines that we had from before. And so we haven't changed that. And I'm sorry that the left-hand side has a lot of green, okay? And it's reflecting off your eyeballs. I'm sorry about that. I'd have to close that, but let's leave it open for just a sec. Now, the big thing about kind of what we see today is yesterday we got above that. That was not a green candle, but we did make a shorter term higher high on the SPX, okay? Now, when we talk about breakout, we like to kind of see a green candle. So that met criteria number one, is it open and close above resistance? But the closing price wasn't above the open. That's why the candle's red. And what you're going to see is this would be the first day of what we call a breakout. And what you're seeing is today we're trading above yesterday's high, okay? And that's why there's that little green dot there, okay? So what I think is kind of interesting is the major break came right around that line that we kept talking about, the 61% line, and then it's just been bombs away since. Now, you might look at this and say, well, geez, this is not really that much. I mean, from here to here, we're talking about the index. In 7 trading days, the index has gone up 5.69%. It almost makes you feel bad for those who are investing in fixed income, and they might only be getting 4.3% for the entire year. Okay, maybe don't feel bad for them because they probably have maybe some capital tied up in that. Just kind of showing a little difference here. 5.69% in 7 trading days, 4.25 for the entire year. Okay. You decide what interests you. Now, if we take also a look at just real quick the NASDAQ, and then we'll look at the sector, still kind of charting away, okay? Kind of pushing up through. This is almost at the 100% line, and it's been the move off the bottom, okay? And I don't want anyone to get sick. Maybe have your trash, a little garbage can close by if you feel a little nauseous. The movement here from the low to, let's say, where we are currently, in 19 trading days, it's gone up 21.7%, okay? So there's been some opportunities, okay, for someone to try to maybe consider a bullish entry. Now, what sector, for example, have you been looking at? Okay, now RiceBird kind of beats us to it. Now, I want to kind of bring this up. So when we look at the sectors for just a moment, I'm going to bring up the IXM. This is the financial sector, the index itself. And there's been a lot of discussion about recession on the back table, a depression. Well, I'll tell you what, I don't know everything. I'm fully aware of that. I'm fine with that. But I don't think investors would be buying financials if they thought there was going to be a recession in the shorter term. Does that make sense? Because these are the banks, the companies that lend money to people. You probably wouldn't be lending money to people if you actually thought that they were going to go in default and the bank was going to be losing money and actually withdrawing down capital. So the fact that the financials are firing back in the magnitude that they are, they might say, hey, we had some recessionary fears, but maybe some of the changes that we've seen in the last week-ish, maybe that was, it was on the table, but maybe we've kind of come back up and maybe taken that risk down. It's always on the table, but when we see the movement we've actually seen in financials, this is kind of interesting, okay? Because again, the banks are really they're the oil of the economy. They are the oil of the stock market, right? Whether you're a retail investor, an institutional investor, all investors in general, you need liquidity, and it comes through the banks, okay? So I want to kind of bring up something just real quick. And I want to kind of talk about I've never really written this down, but I need to really hear, okay? Now, what I'm going to do is I'm going to kind of go a little faster. And the situation is, okay, so the situation is you see a breakout, okay? You see a breakout and you say to yourself, I'm going to look, well, I should say the investor is going to look for a bounce setup, okay? That's what we said before, right? Now, the biggest thing I want to bring up here is when we actually see, let's say, number one, a breakout. We already defined what that means to us, okay? Green candle above the line. And what does the green candle mean? Closing, open and close above the resistance, closing price above the open. Want to see the closing price above the open so that way it didn't just pop up and fade, okay? The second part of that is the big thing is when we talk, number one is the breakout. And the second thing I want to really talk about is when we actually get, let's say, down days, okay? So when I say down days, I'm referring to red candles, okay? Now, if the price is above the shorter term moving average, the expectation, okay, and sometimes the pattern that we tend to see is the price tends to pull back less than 3 days. Now, let me repeat this. So when I say price tends to pull back, we're talking about red candles, okay? Now, here's the deal that we also need to understand here, kind of a little highlight. If the stock pulls back less than 3 days, okay, red candles again, saying it again, red candles. The biggest actually thing is this is not a bad sign, okay? The sign of potential, momentum, and trend, okay? So now, if we take a look at this, okay, when that stock actually pulls back, and we're going to look at some examples, just want to write this down so it sinks into our mind. When the stock pulls back, okay, when the stock pulls back, what to watch for? All right, here we go. Now, number one, let's just say number one, I'll be watching candlesticks, okay? So in other words, if we actually saw something that A, broke out and now is starting to pull back red candles, what type of candlesticks are we starting to get to maybe show signs of bouncing? Well, candlestick, let's start here, okay? Now, what type of candlesticks, if we're looking for a bounce? So this is where we're looking, we're going to kind of call this, we're looking for a bounce setup after the breakout. So what are we watching for? Well, candlesticks. What type of candlesticks? We're definitely watching a bullish engulfing, okay? Bullish engulfing. Second one we're watching for sure is a piercing line. And if you say, I don't even know what these are, you want to go to the online course and say it's time to get serious now. Playtime's over. The other one we actually want to know for sure is a hammer, okay? So if we start to see these candlesticks, we broke out and as the prices pull back, red candles, and then we start to see any of these three candles, you know, these are early signs, okay, of bullish interest, okay? Now, these candlesticks, if they're happening near support and we're seeing those bullish candlesticks, well, someone's obviously using technical analysis in that case, okay? Now, we'd also like to pay attention to the wicks or tails. We have seen so many examples lately of where the price sold off right to the moving averages or the moving average, okay? And then intraday bounce right back up. Now, someone could have done a buy limit order, okay? Someone, for example, could have, let's say they were just doing manual entries. They were watching that and then they got in. It could have been both, okay? Now, when we also take a look at the last one that I'm going to pull up before we look at examples is definitely if we start to see something like Cohold, what you got to understand is Cohold is really just a most likely a bullish engulfing, and we're just closing above the high of the low day. This is where it's actually the prices pull back, and then the price pushing back up to a short-term high. And when you say short-term high, what do you really mean by that? Probably the last 3 to 5 days, okay? So the price is pulled down, and then it's come back up. In the shorter term, it looks like a very much like a short-term V. Now, also with this, we would include a CHE, and we've seen a ton of these. Don't even say you haven't seen a ton of them. You might not have recognized them, but they are there. The CHE at close higher gap. The CHE candle setup is really a three-day approach where you get a red candle down, you get an up day, and then you get the gap entry. Let me just draw that one just to make sure we're 100% clear before we go look at these examples, okay? So when we actually talk about this, right, red candle, and then all of a sudden you see like a green day, and it's not Cohold yet. If we said what red candles do we have, there's 1 and 2. We want the price to get above really the high of day 2, and it didn't. This day is not all lost, but the investor really wants to see what does it do the very next day in the morning, the first 90 minutes of the market. And if that stock, for example, opens up higher, okay, if we open up higher than the previous day's close, that's what we call the price is gapping. And some traders, they like to buy in the morning, okay? And that price is gapping up. Now, does that guarantee that the stock is going to go up higher after a gap? No, but it is actually showing some interest after yesterday's potential bounce setup, okay? Now, historically, they said things like, well, yeah, the first 90 minutes is rookie hour. And my comment always back to that is, but these rookies have a lot of money. I mean, if you're causing some of those stocks to gap in that magnitude, I wouldn't laugh too much because that's actually a lot of volume, So I think done are the days of saying that, oh yeah, they're just rookies or retail investors. That's not that funny. And I think we've actually seen really over time that retail investors can significantly push prices up or down. I think as some of these institutional investors found out. Okay. Welcome to the retail investor and not just the little person anymore. All right. Now, I want to kind of just see, are there any questions first off? Any questions? Now, just real quick, just want to actually see. Now, yeah, so the comment from Josh, very important. The price moves before the market opens. That's why it is also important to kind of look at where the futures are. Okay. So let's say Dow futures like this morning, we're up plus 300. Well, if the Dow futures are up plus 300, you probably know that there's probably going to be some better chances of gapping. Okay. Now, if we saw the Dow futures down 500 or whatever, well, probably going to get gapped down. So that's why people look at the futures to kind of get an indication of, is there likely to be gaps? Wonder if the Dow futures are only at 20 points on the Dow. Probably not going to see a lot of gaps. None, I didn't say that, but just less. Okay. Now, let's now, by the way, what we talk about here, when we talk about candlesticks, wicks, tails, and hold and close higher gap, this could be applicable to a daily chart and a weekly chart. It doesn't matter. It could be applicable for stocks, options. It could be applicable to ETFs, like we talked about earlier today, and also other products as well. Okay. Now, I want to kind of take a look at some examples and I'm going to give you 3 practice examples. And then what I'm going to do is I'm going to test you. It's easy to look at a chart and historically say, well, I would have gotten in here. I mean, when you look back, it's easy. But then after we actually learn from these 3 examples, I'm going to take you to new ones. And then all of a sudden you can't see the future. And all of a sudden that dominant answer of, yeah, I would have gotten in here. That's exactly what I would have done. I'm going to actually see if you're that confident on the examples we're going to look at today. All right. Okay. Now, here we go. Now, let's go ahead and actually take a look at 3 examples. Speaking of financials, okay, I'm going to go back to, let's say, JP Morgan for just a second. And if you take a look at this, I want to kind of isolate on this point right here, okay? So here's kind of the little pullback, right? Red candle, red candle, red candle, right? We define down days as red candles. If we look at this day, is that close above the high of the low day? It's not, because we didn't close above the previous day's high. That was the lowest red candle. And if you said, well, I'm confused. When you say the lowest red candle, which one do you mean? Well, identify the lowest, most recent red candles lately. We're not on this day yet. It's day 3. We did not close above day 3's high. That's all it is. Okay. Now, are we always going to have 3 days down? No. You need to be prepared that if it's only 1 day down and then go hold, people are buying on a shallower dip in price. If it's a 2-day pullback, red candles, and then it's go hold, close higher gap, etc., be prepared. If it's 3 days, the price had to fall down lower to get bulls to step in to buy. The problem is we're always thinking that, oh, I'm waiting for a deeper pullback. I want more confirmation, 2 weeks or so. Look, if it's really breaking out, a week or 2 pullback after a breakout, that might even be a bad sign, okay? If it just broke out, it made a higher high. And if it makes a higher high, it should be making a higher low, or could be. So the investor is really trading the breakout and trying to get a bounce setup. He's not looking for a 1 to 2 week pullback. That wouldn't necessarily be a great sign for many technicians. Scott's, any thought on that? Okay. Now, if we take a look at this, I'm going to go to this to the right-hand side. Now, this was the first. Now, notice the very next day. If I ask you a question like, what is the most recent red candle or candles? Well, James, there was only one of them. So I'm going to circle that. Let me repeat the question. So what was the most recent red candle or candles? Because we don't know if it's going to be a 1, 2, or 3 day pullback. Okay, so we had a red candle right there on about the 21st. And then what happened the very next day? Well, there's the breakout. Now, the other thing that we kind of need to make sure we shore up is do not always assume that all breakouts are going to be horizontal in nature. It's not true. Matter of fact, some of these diagonal breakouts, if you're a flag investor, you might like these diagonals. Diagonal, okay? Now, these diagonals, these tend to really be probably a 5-day, maybe a 10-day, if we're looking kind of a classic flag, 5 to 10-day line where you can kind of get an indication of where that resistance level might be. So I'm going to put an X on the first day we actually saw a hold, and we can see that green dot signifying close above the high of the low day. That doesn't guarantee the stock's going to go up. It's just showing at that moment in time, someone bought the diagonal breakout. Someone bought the close above the high of the low day. Okay, fine. But this point in this class was, okay, I saw the breakout, but I want to get in on the higher low. I want to get in on the bounce. So now our job is to actually see where the bounce is, okay? Now let's kind of go day by day. So the very next day, the stock gaps up. What in the world happened, okay? Well, let's say the Dow futures were up plus 300, whatever, or JP Morgan had some news about it. How does the stock close at 235 and then gap up to 240? Well, you got to understand that the official market time is 9:30 Eastern to 4, but you got to understand that there's pre-market trading too, especially on some of these liquid stocks. They could buy and sell that many of these stocks in the pre-market, okay, before 9:30 a.m. Eastern. So, and by the way, some of the stocks just might have a lot of orders that were put in at night or early in the morning and then filled when the market opened, okay? And they were overwhelmingly orders to buy, and it knocks the stock price higher. Now, so if we look at the very next day, we're looking for a red candle, okay? So it's not red candle, not red candle. Okay, now what do we got, okay? So the investor says, well, James, you know what? I wanted to get in here, but I haven't had a chance to get in yet. Now, how many of you have ever had that where you said, James, I saw the breakout and I'm looking for an entry to get in? Now, this is a nice plug for why this class does not look at 2,000 stocks a day, okay? This class really looks at Dow 30, NASDAQ 100, and the S&P 100. Some of the Dow stocks are in the NASDAQ and the S&P 100, and some of the S&P 100 stocks are in the NASDAQ and so on. So our universe of stocks is probably about 200 in totality, okay? Unless we're looking at specialty type stocks in the S&P 500, like cruise ships, like home builders. But that is a minority. We're going to say like 5% of the time or less. 95% of the time, we're looking at only a universe of about 200 stocks total, okay? Now, if we're seeing this on the very next day, now Scott always actually said a phrase, what would you need to see, okay, to consider a bullish entry? Now, Scott, did I just bloody that phrase up? What would you need to see to consider a bullish entry? Now remember, you told me, hey, I'm waiting for a breakout. Fine, it happened. Now we're waiting for a bounce entry. Well, what does the bounce entry look like? Well, we talked about it, right? If the prices are above both of the moving averages, that pullback might only be 1, 2, 3 days. And I got to be watching for candlesticks, bullish engulfing, piercing lines. I got to be watching for hammers. Second, I need to be watching for wicks and tails of candles to see our buyers buying off those support levels. If the bounce is starting to occur, close above the high of the low days, close higher gaps could be shown, and I need to have an understanding of what those are. And by the way, what's nice about this, or what I'm talking about, is this is the way it's been for the last years. I mean, Scott, we've been doing this for 20 years, okay? So this is a nice thing. Once it sinks in your brain, it just like, like it doesn't change, okay? And it's kind of nice. Now, what are you going to see is we've had a 2-day pullback, 1-day pullback, 2-day pullback. Now, what I'm going to do is I'm going to say, okay, which day has where are my red candles? And we could circle those. 1 day, 2 day. Now, I don't know what tomorrow brings. I have not an earthly clue. But what we do know is which day is the lowest. It's day 2. We're looking for the price to get above that high. Okay. Now, what this really does is you're going to notice that successful people in general, they tend to be focused. Successful people in general, they tend to be disciplined. Okay. So probably an average person at this point, they're not even focusing anymore. Okay. They're not focusing on the same stocks over and over again. They're looking for some secret watch list, and hopefully it's going to bail them out of not being focused and disciplined. Good luck. Okay. So the investor, they're probably watching a smaller universe of stocks, and they're watching daily for those setups. Now, don't worry, I'm going to come to how can you find them. Now, if you look at this the very next day, was that an entry? Now, I'm testing you right now. Was this an entry? Yes or no? Was that an entry? Well, that's part 2 of what we talked about, right? That's not close above the high of the low day. That's a close higher day. The close higher gap is a 3-candle formation. It starts with a red candle, check. Second candle is a green candle that does not close above the high of the low day. And the very next day, the price would need to gap. Well, let's go take a look at the next day. So the answer is that's not an entry, okay? Per what we talk about in our examples of what we wrote down. The very next day, is that an entry? Well, you're going to see that, let's assume that didn't gap to the upside, and it's kind of like the exact same day. So the answer is no. We go forward to the very next day. Is it a gap? It's not. This is very unusual, 3 days in a row, but by the end of the day, what has happened? Green dot there. And what you're going to see is we closed above that day's high. That's why that dot is there. So an investor might say, James, I'm going to take a bullish entry right there. And some investors might say, James, I'm going to take this recent pullback and just set that stop right underneath that pullback area. These shallow, shorter term pullbacks can act like higher lows. Okay. So the investor says, okay, I was looking for a gap, just didn't get it. Okay. Second, and even if they did, it didn't go anywhere. If they didn't buy the gap, what you're going to now see is the stock then on 5-1 did close above the high of the low day, which the low day on the red candle was right there. So now all of a sudden, what do we see? Well, yeah, I was waiting for the gap, but what you're going to see is the previous day at the close, okay? You're going to see there was a potential setup, and then today just other investors see that, and then there's the gap. So first I want to address, okay, how does the investor find these setups? Does anybody want to know the answer to that question? Thank you for coming today. Next week, I'm going to let you know the answer to that question. Okay, I'm joking. I desperately want to tell you right now, I can't wait any longer. So the reason why that we actually talk about indexes, okay, indexes and sectors, is we're trying to find where is the MOMO and the trend. So in other words, if I pulled up the NASDAQ and I saw it was above both moving averages, nice upward trend, then finding stocks in the NASDAQ probably shouldn't be too hard. Second, if I pull up the sectors and see that, let's say, financials is one of the stronger sectors, then finding stocks in those areas in that sector should not be that hard. Okay, does that make sense? So when we bring up indexes and sectors, that's not trying to waste 5 minutes of a webcast. We're trying to isolate where are we going to see the bounces so it makes sense when we pull up the charts. Okay, now what I want to do in this case is number 2. So how do we find, okay, the setups? Where are we likely going to see these? Look at which indexes are actually showing the strength. Second, which sectors are showing the strength. Now, when I bring this up, I'm just going to pull up, let's say, the Dow Jones. I'm going to pull up the sectors for just a moment. How would I know which sectors are performing the strongest? Okay. Well, number 1 is we could just look at a week percent return, and we could just rank it from top to bottom. That'd be pretty simple to do. Okay. Need a list of sectors, but once we have the list, then it's not too bad. Second, I could also go to the RS5 and I could actually see which sectors are actually getting the strongest strength relative to the S&P 500. Now, if we did that right now, which sector is leading? It's technology. Second one, industrials, discretionaries, consumer service, communication services, excuse me. Those are the four sectors we keep talking about when we draw the quadrant of are investors willing to take risk. When we look at the R as 5 days or the 10 days, it's technology and industrials. The financials are the one help me say it today that is actually getting a little push here on a 5-day. That's why we're bringing it up. Okay, so that's how we can kind of find where could we actually probably see some setups. Now, what I want to do is I want to pull up some new examples. Okay. Now, when you look back, you always say, we all say like, oh yeah, I would have gotten in right here. I mean, that's where I would have nailed this thing. And looking back, I would have gotten in right there. And this is what we tell our friend when we're going fishing. Okay. I would have nailed that thing right there. And then your friend says, well, are you in though? And you say, well, you know, I've been busy. I had to take Buffy to the vet and things have been real busy. Well, okay. So maybe the investor gets sick of that after a while and says, okay, there's like the learning of it. And then am I at the point where the investor says, I'm willing to practice now, not just talk about it. Okay. Now here's what we're going to do. So let's go ahead and I'm going to pull up a stock. If you don't mind, I'm going to bring up, let me take a quick peek. And the example that I want to pull up for just a second, let's pull up, I'm going to pull up Amazon for just a second. Okay. Now, notice on Amazon for just a moment, this stock has actually been pushed down and it's kind of been right up against an area of resistance, okay? Now, what you're now going to notice is, what does this chart have to do with what we talked about? Well, this kind of ran to the upside, went down for a day, closed lower than where it opened, fired right back to the upside, gapped up on the price, and then what you're going to see is it went down for a day. People picked it up as the price dropped. People picked it up as the price dropped from where it opened. What type of candle is that? What type of candle is this? Okay. Well, that candle right there, if we're kind of saying, what does it look like? Kind of looks like a hammer candle. Where do you tend to get hammer candles? Near support. Now go forward to the very next day. The stock gaps up in price. Remember we kind of talked about wicks and tails? Where do you tend to see wicks and tails? Okay. If these wicks and tails are near moving averages, okay. Now, if we had wicks and tails near the 10-day moving average, price is able to hold more momentum. Second, if we actually, for example, saw that the wicks and tails are actually near the 20-period moving average, price is having to fall down further to get buyers, but the buyers are showing signs that somebody is, not me, okay? Someone is buying near the moving averages. Now, this is where the investor might say something like, well, I'm going to wait for the breakout. Fine. Now, the reason why I bring up Amazon first off is, where could you find stocks that are first starting to break out? Now, this is a very important question because we don't always want to be like, in hindsight, how do we find stocks that are breaking out? That's a question. Well, the number one script that we actually talk about is the 20-day high, okay? If you get a stock that's making a 20-day high, even intraday, this is the sign that it is starting to break out. The 20-day high is not asking, did it open and close above the resistance, closing price above the open? It's not asking that. It's just saying it could even be an intraday high. Now, when we pull this up, we could say the 20 or 55-day high, okay? Either or. But the most realistic, it's going to be the 20-day high. This is like a laser sensor. Are we actually starting to get really a breakout? Now, the other place that we could really find is it maybe starting to get a little breakout is we can also see in that second column, which is the breakout, okay, script, okay? Now, let me kind of just tie something together. I just want to make sure we're clear on. When you look at a 20-day high breakout, 55-day high breakout, etc., or you actually look at a Cohold script, and I'll say Cohold or CHG script. These scripts right here that I'm highlighting, those are showing today. Today. The breakout script, which I'm going to isolate on, is really a 3-day script. Let me show you what I mean by that and where we could see these. Now, what you're now going to notice, if I go to the market watch, you're going to see that there's a couple stocks here, and we're looking at the sector list. Remember we talked about breakouts? How can I see the breakouts? Well, right here. Now, here's the deal. If you put this on your Thinkorswim platform, and let's say you put it on your platform, and you pull up your mobile phone or your tablet, etc., these scripts can also be on your mobile device. They're not color-coded like this, but they would show the numbers, okay? And so you're going to see that we have the daily breakout, okay? Now, the Cohold, the 20-day high, 55-day high, these are price action today. Now, if we go over here to the right-hand side, now, by the way, let me say something. That 20-day high, if you said, well, how would I see breakouts? I always feel like I'm late. Then that investor should probably be focusing on which stocks or sectors are actually hitting 20-day highs. Because if someone says, I don't want to always try to buy on the bounce, I'd like to maybe potentially consider the breakout. Well, 20-day high breakouts probably the way to look at those. But you could also go back to, if you're seeing a whole bunch of sectors or stocks that have a strong trend, there's a very good likelihood that they're probably going to be breakouts potentially as well. You picking up what I'm laying down? Reading my mail? Okay. Now, let's get to what we want to really get to is, but wonder if we break out. Now, the breakout script could show that we're today breakout. This does not mean today bad odor. Today breakout. And what you're going to see is they'll also have other terms like continuing 2 days ago, or continuing 1 day ago, and so on. What you're now going to notice is the color, the green background is showing, remember, scripts, not guaranteed for accuracy or timing. You should have an understanding logically of what the script is trying to do, and that visually that you could identify it on the chart to verify is the script being accurate and timely, okay? And is it the setup that you're actually looking for? Now, what we're going to do is we're going to right-click on this breakout, going to go edit formula. And once we do that, you're now going to see that it will say the script is meant to find stocks breaking above resistance, green, or support, okay, red, in the what? The last 3 days, okay? So remember the difference when you look at Cohold, that's today. When you actually look at 20-day high, today. You look at the 55-day high, that's today. But this breakout script, if someone says, look, I'm around that sensitive area of resistance and I'm waiting for that bounce, that breakout script is not meant just for today. It's over the last 3 days, okay? Now, if you don't have the script, I'm sorry, okay? I'm sorry that, you feel like, James, why are you telling us now? Now, I'm also trying to kind of really drive some points home that I think maybe the clarification where maybe there's lack of understanding and there's just failed execution of practice, okay? Now, what I want to do here is I want to bring up, so I talked about Amazon, okay? Hopefully that helps. This one's kind of showing a little wicks. Now, if we looked at this right now, we might say, well, it's not broken out yet. Some investors, what they do is they don't wait for the breakout. They're actually buying assuming that it could. Now, what I'm going to do in the last 5 minutes, you might be surprised by this. Number one trade we're going to do here today is we're going to sell some of those. We're going to sell a put, okay, right on Amazon. We know selling a put, you have an obligation to buy the stock at the strike price from now to expiration. And what I'm going to do is, let's say the investor says, I'm going to sell the 185 put, okay, and I'm just going to do this in the short term. We could even go to the June. We're going to sell just a single. Now, what we could also do is if we wanted to, we could sell the 185 and then just buy an out of the money long dated put, or I should say a lower strike put. That way we just define the risk. And just for time's sake, I'm going to do the 145 way down on the table. Okay. And if you look at this, I'm going to put 145. And what that does is it defines the risk, got to pay the 10 cents and the commission, but that way it doesn't tie up as much capital, does reduce actually the net credit, but we're going to do that to try to make it where it's not tying up as much capital in the IRA account. Note the extra commission, going to send the order. Now, the one thing I want to kind of bring out here is on that list, if I added Amazon to this list, I want to kind of look and see, is Amazon showing anything on here? And let's kind of wait for this to load for just a sec. There's Amazon. I just put in the list. And if I looked at this, I just want to kind of look and see, is it starting to kind of show any potential breakout yet? Okay. Now, what you're now going to notice is not showing a breakout yet, but notice it just has a red background with the number 1, which means it dropped down on the 10-period moving average in just the last day. If you see something like that, that could be a sign that this could be a shorter term flag, especially if that 20-period moving average is still green. Okay, now let's actually look at this trade example number 2. Okay, now let me just kind of clarify what I said. Notice that the underlying moving average, the 20-period moving average, it's still green. Have you ever seen it where the stock runs to the upside and then the stock pulls back and maybe that shorter term moving average just goes red for 1, 2, 3 days or so? Sure, we've seen that a lot. When you go back to the market watch, that's what Amazon is showing right now. Red, just down for a day, but the 20-period moving average still green for the last 7 days. Okay? Now, let's look at a different one. Let's go back to Meta for just a second. And if you look at Meta and then kind of go back to where we were here, you're going to now notice that if we look at this, price, red candle, what type of candle do you see right here? It's a bullish engulfing. Okay, go for it. Very next day, gaps to the upside. Okay, very next day, what do you see? Red candle. Now remember, I used to think that red candles were horrible. Okay, it's horrible. That's why I used to, you can make fun of me. It's fine now, okay, now, okay? But when those red candles, I didn't understand the red candles, as long as the price is above support, that's the opportunity, right? That's the setup of someone who's trading the bounce, okay? So red candles are your friend as long as the price is still above the moving averages. And maybe that stock hasn't pulled back for more than 3 days. Let's look and see what happens. So it pulls a red candle. And then what type of candle do we get the very next day? What type of candle? Well, is that a close above the high of the low day? That's not close above the high of the low day, okay? That's really that 3-candle formation. Down day, red candle, close higher. The investor, if they have an understanding, they're probably saying, James, I'm looking for that gap to the upside. Or if it doesn't gap to the upside, I'm looking for that close above the high of the low day, the investor might say. Go for it the very next day. Stock does not gap to the upside, doesn't, go to the earnings, and now what you're going to see is the stock gaps to the upside. Now remember, it didn't really give us a chance to get in, okay? And then it gaps. Now again, red candles are horrible. Well, not if the investor's trying to get in on the bounce. The red candles mean the stock is coming down closer to the moving average, which could act like support. Go forward to the very next day. And now what you're going to see is if the investor said, James, I'm looking really for a close above the high of the low day, okay? You're now going to see that this right here, that's the first day that we've actually seen close above the high of the low day. Now, I know what you're thinking. James, I wish I could have seen a little close higher and then a gap a little bit closer to the moving averages. The one thing we also want to kind of also remember is when you look at a stock, if the investor's buying the stock probably within a 3% window of the moving average, to get a signal, that's about as close as you can get, okay? If you got a signal. If the investor says, James, I'm buying the stock in the window between the moving average and current price, 5%, sometimes to get a confirmation, the confirmation ain't free, meaning the stock has to bounce to the upside. If the investor says, look, I bought the stock 7% off that moving average, now the investor is probably a little later into that bounce. The last and final trade here we'll just do to set up, we're going to do a short put vertical in closing on Meta as that stock tries to push itself into that old channel. And on Meta, what we're going to show in this case, quickly, we're going to look to actually sell the 5, okay, the 590 and then buy the 585. Okay, so this is a short put spread. Okay, and we're going to sell the 590 and then buy the 585. Now, your homework, I want you to go back and catch the recording on this, especially where we talked about what we wrote down. Do you have an understanding of that? You're actually looking for really certain candle types. You're looking for tails near moving averages. You're looking for Golden CHG. You are trying to identify that so you can actually see the bounce. Make sure also that you have those scripts set up so that way you can identify stocks that have broken out or currently are in the process of breaking out and bouncing. So this is very much actually worth going back to restudy it. You're going to see it again and again, and you want to be prepared and know what you're able to see on the chart, and you have confidence in what you're seeing. Now, with that said, I'm out of my time. Stay tuned for our next webcast coming up right at the top of the hour. Quick reminder that you could also follow us right on X, okay? And also you can subscribe right on YouTube, our channel there, Trader Talks at Schwab Coaching. Thanks, Scott Thompson, for answering the questions in chat. I took this topic because a lot of people asked me to talk about it, and I thought today would be a good time to actually bring it up. So with that said, stay tuned for our next webcast coming up right at the top of the hour with what we discussed. Remember that all investing involves risk, and this has been the class on advanced charting techniques. Thank you so much. Bye-bye.